Hi everyone, welcome back to Corporate Decoder, the place where we break down the complex world of corporate finance, so you don't have to. And sometimes the simplest agreements hide the biggest stories in the corporate jungle. Today we're diving into a filing from Ivanhoe Electric Inc., an interesting company operating in the mining and energy sectors. They've just announced the termination of a significant agreement, and we're here to decode what that means for their future. Before we get into the nitty-gritty, if you like getting clear, actionable insights from these official documents, make sure you're subscribed. We also have a fantastic Discord community where we discuss these filings further, linked in the description below. Jump in and join the conversation. So what's the big news here? Ivanhoe Electric Inc. is calling it quits on a pretty important contract called the Amended and Restated Shareholders Corporate Management and Cost Sharing Agreement. Now that sounds like a mouthful, but what it essentially boils down to is an arrangement they had with other companies, including Global Mining Management BVI Corp and Global Mining Management BVI Corp and Global Mining Management Corporation, to share the costs of keeping the lights on and the business running smoothly. This agreement started way back in 2013 and has been updated since then. Ivan became a part of it in 2021. Think of it like a shared office space and support team. Under this agreement, these companies shared office facilities. And more importantly, they shared the cost of administrative staff. We're talking about people who handle accounting, corporate tasks, secretarial duties, HR, financing, legal support, IT, and general management services. These are the folks who make sure the company is running day to day and staying on the right side of regulations. Now here's the key part. Ivanhoe is giving 60 days notice, meaning they're opting out effective October 31st. And the big takeaway is that Ivan is now stepping up and taking on all of these responsibilities themselves. This means they're bringing all those critical back office functions in-house. Let's think about what this really means. When companies share costs like this, it's usually to save money, especially for smaller or newer entities. By terminating this agreement, Ivanhoe is signaling a few things. One, they're likely growing to a point where they feel they can manage these functions more efficiently on their own, or perhaps they need more control over these essential services. Two, it could be a strategic move to streamline operations and potentially reduce long-term costs, even if there's an initial investment to build out their internal capabilities. Three, and this is where it gets interesting from an investor's perspective, it might mean they're separating themselves from the other parties involved in the agreement, especially considering that Global Mining Management Corporation is partly owned by Ivan Agreement, especially considering that Global Mining Management Corporation is partly owned by Ivan in Duff Dempabilities. Three, and this is where it gets interesting from an investor's perspective, it might mean they're separating themselves from the other parties involved in the agreement, especially considering the Global Mining Management Corporation is partly owned by Ivan internal capabilities. Of course, we always want to look at the bigger picture for Ivanhoe Electric. They're listed on the NYC American Exchange under the ticker symbol IE. Their common stock is what most investors would trade. This cost-sharing agreement termination doesn't directly involve their stock price in this particular filing, but it's part of the operational backdrop. The operational influence shows the company's performance, and by extension, its stock value. Now, while this filing is primarily about the termination of an agreement, it's essential for us to consider how this fits into Ivan's select rate in capital-intensive industries. Mining and energy, where managing overhead is crucial. By bringing shared services in-house, they're taking on more operational responsibility. This can be a double-edged sword. On one hand, it can lead to greater efficiency and cost savings in the long run if managed well. On the other hand, it requires investment in infrastructure, technology, and skilled personnel. If they don't have these resources in place, the transition could be bumpy and potentially more expensive than anticipated. Compy and potentially more expensive than anticipated. We haven't been given specific financial tables to dissect in this particular 8K, which often focuses on significant events rather than detailed financials. However, the implications of Ivan taking on these management and cost-sharing responsibilities entirely are financial in nature. We'll want to keep an eye on their future financial reports, specifically looking at operating expenses related to administrative and management functions. Is there an increase in salaries, benefits, office space, or IT infrastructure costs? If these costs rise significantly, we'll need to see if it's justified by improved efficiency or a clearer operational focus. Conversely, if they manage to absorb these costs and reduce overall administrative overhead compared to what they were paying under the shared agreement, that would be a strong positive signal. Think of it this way: if a company shares a large HR department with several others to save money and then decides to build its own, it's like moving out of a shared apartment into your own house. Initially, you have to pay for everything yourself: the mortgage, utilities, furniture. But over time, if you manage it well, you might find it's cheaper or you have more control over your living space. Ivan mortgage, utilities, furniture, but over time, if you manage it well, you might find it's cheaper or you have more control over your living space. Ivan mortgage, utilities, furniture, but over time, if you manage it well, you might find it's cheaper or you have more control over your living space. Ivan Bix signed rapport, you have more control over your living space. Ivan mortgage, utilities, furniture, but over time, if you manage it well, you might find it's cheaper or you have more control over your living space. Ivan mortgage, utilities, furniture, but over time, if you manage it well, you might find it's cheaper or you have more control over your living space. The filing is signed by Taylor Melvin, the President and Chief Executive Officer of Ivanhoe Electric. This reinforces that this decision is a strategic one made at the highest level of the company. Having the CEO sign off on an 8K report like this highlights the importance of the event. It's not just a routine administrative change, it's a deliberate step in how the company operates and manages its resources. Looking at the broader context for Ivanhoe Electric, they are involved in innovative energy and mining technologies. Their focus often includes projects like deep mining and advanced exploration. In such environments, robust and well-managed administrative and operational support is critical for success. Making internal changes to these functions can have a ripple effect, impacting everything from compliance to the speed at which they can execute projects. In my assessment, Ivan Electric appears to be making a calculated move towards greater operational control and potential long-term efficiency gains by bringing these shared services in-house. The strength of this move will depend entirely on their execution. A weakness could be the upfront cost and the potential disruption during the transition period. An opportunity lies in achieving greater synergy and perhaps even better service delivery once these functions are fully integrated. A significant risk would be an increase in overhead that outweighs the benefits, or if the move distracts from their core business of exploration and development. Ultimately, this termination of the cost-sharing agreement is a sign of a company evolving and taking more direct command of its operational backbone. It's a step that could lead to greater savings and agility, or add initial costs and complexity. We'll be watching their future financials closely to see which way the scales tip. Alright, that's our deep dive into Ivan Electric's latest announcement. What are your thoughts on this shift towards bringing services in-house? Do you think it's a smart move for the company's future? Let us know in the comments below. If you found this breakdown helpful, please give this video a like and subscribe to Corporate Decoder for more insightful analyses. And don't forget to join our Discord community through the link in the description to continue the conversation. Thanks for watching, and we'll see you in the next one.